Hey there, what's up everybody? Welcome to today's video on common mistakes to avoid when investing in the stock market. My name is David from the Wealth Insider Club, and I'm an experienced investor who's been in the game for a while now. Now, we all know that investing in the stock market can be pretty risky, but that doesn't mean you should be scared to invest your money. With the right strategies, you can avoid common mistakes and achieve financial success. And that's exactly what we're going to talk about in today's video. So, whether you're a newbie investor just starting out, or a seasoned pro looking to refine your strategies, this video is for you. We're going to cover some of the most common mistakes that investors make when investing in the stock market, and show you how to avoid them. But before we dive into the nitty-gritty, let me just say that investing in the stock market is not a get-rich-quick scheme. It takes time, patience, and a lot of hard work. But if you're willing to put in the effort and follow these strategies, you can achieve financial success and grow your wealth over time. If you're watching my video for the first time, I invite you to subscribe to my channel and turn on notifications. I regularly share free wealth creation wisdom from successful business people, which can help you improve your financial and business thinking. So, without further ado, let's get into the meat of the video and talk about some of the most common mistakes that investors make when investing in the stock market. 1. Investing without a plan. The first mistake new investors often make is not having a clear investment plan. I get it. Investing can be intimidating, and it's tempting to jump right in without a plan. But trust me, taking the time to develop a sound investment plan is crucial to avoiding poor decision-making and potential losses. So, where do you start? Well, the first step is setting clear goals. What do you want to achieve through your investments? Are you saving for retirement, looking to grow your wealth, or just trying to make some short-term gains? Once you have a clear idea of your goals, you can start to develop a plan that aligns with them. Another important aspect of a sound investment plan is diversification. This means spreading your investments across different types of assets, such as stocks, bonds, and real estate. By diversifying your portfolio, you can help minimize risk and maximize potential returns. But diversification isn't just about investing in different types of assets, it's also about investing in different sectors and industries. For example, if you invest all your money in tech stocks and the tech industry experiences a downturn, you could suffer significant losses. By spreading your investments across different sectors, you can help protect yourself from these types of market fluctuations. Now, let's talk about monitoring your progress. This is an important aspect of any sound investment plan. You want to regularly review your investments and make adjustments as needed. This might mean rebalancing your portfolio to ensure that it remains diversified or selling off investments that are underperforming. The bottom line is, having a clear investment plan is key to avoiding common mistakes when investing in the stock market. By setting clear goals, diversifying your portfolio, and monitoring your progress, you can make informed investment decisions that align with your long-term financial goals. But, as we all know, the stock market can be unpredictable, and even the most well-crafted investment plan can fall short. So, let's dive into some other common mistakes to avoid. 2. Following the herd. Alright, let's dive into the next mistake new investors often make, following the herd mentality. This is a big one, folks. Many investors make the mistake of buying into popular stocks or trends without conducting proper research or analysis. They hear their friends or family members talking about a hot new stock, and they want in on the action. But this can be a dangerous game to play. Why? Well, popular stocks or trends can be overhyped and overpriced. And when the market inevitably corrects itself, these stocks can experience significant drops. If you've invested heavily in these stocks without conducting proper research or analysis, you could be in for a rude awakening. So, how do you avoid this mistake? The first step is to conduct thorough research. This means looking beyond the hype and analyzing a company's financials, management team, and competitive landscape. You want to make sure you're investing in a company that has a solid business model, a strong track record of performance, and a competitive advantage in the market. Another tip is to seek expert advice. This could mean talking to a financial advisor, reading up on investment strategies from reputable sources, or following the advice of successful investors. By seeking out expert advice, you can gain valuable insights and perspectives that can help you make informed investment decisions. And finally, taking a long-term investment approach can help you avoid the pitfalls of following the herd mentality. Instead of trying to time the market or make short-term gains, focus on building a diversified portfolio of high-quality investments that align with your long-term financial goals. This can help you weather the ups and downs of the market and achieve sustained financial success. So, to sum it up, don't fall for the hype. Conduct thorough research, seek expert advice, and take a long-term investment approach to avoid the dangers of following the herd mentality. 3. Overreacting to short-term market fluctuations. Moving on, let's talk about the mistake of overreacting to short-term market fluctuations. Now, we all know that the stock market can be volatile, and it's natural for investors to get anxious when the market takes a dip. However, many new investors make the mistake of panicking and selling their stocks during market downturns, which can lead to missed opportunities and lower returns. So, what can we do to avoid this mistake? Well, the first thing to keep in mind is to stay focused on your long-term goals. Remember that investing is a marathon, not a sprint. Don't let short-term fluctuations derail your long-term plans. Another important tip is to maintain a diversified portfolio. By spreading your investments across different asset classes and industries, you can reduce your overall risk and increase your chances of success. This way, even if one sector or stock performs poorly, you won't be overly exposed. Finally, it's important to avoid emotional decision-making. When the market takes a hit, it's easy to let fear take over and make rash decisions. However, it's crucial to stay rational and objective. Instead of making knee-jerk reactions, take a step back and evaluate the situation carefully. Seek out expert advice if necessary and make decisions based on sound research and analysis. By following these tips, you can avoid the mistake of overreacting to short-term market fluctuations and stay on track towards achieving your long-term financial goals. 4. Failing to diversify your portfolio. Now we're going to talk about the importance of diversifying your portfolio. One of the most common mistakes that new investors make is putting all of their money into one stock or sector. This can be really dangerous because if that stock or sector experiences a downturn, you could end up losing a lot of money. That's why diversification is so important. When you diversify your portfolio, you spread your investments across multiple sectors, asset classes, and geographic regions. This can help to reduce your risk and protect your portfolio from market volatility. So, how can you diversify your portfolio? Well, one way is to invest in different sectors. For example, you might invest in technology stocks, healthcare stocks, and consumer goods stocks. This way, if one sector experiences a downturn, your other investments can help to balance things out. Another way to diversify is to invest in different asset classes. This might include stocks, bonds, real estate, and commodities. Again, this can help to protect your portfolio from market fluctuations. Finally, it's also important to diversify across different geographic regions. This means investing in companies from different countries and regions around the world. By doing this, you can take advantage of growth opportunities in emerging markets and protect your portfolio from economic and political risks in any one country. Overall, diversification is a key strategy for successful investing. By spreading your investments across multiple sectors, asset classes, and geographic regions, you can reduce your risk and increase your chances of long-term success. 5. Ignoring fees and expenses. Let's talk about another common mistake that new investors make, which is ignoring fees and expenses. Many investors focus solely on the potential gains from their investments and overlook the costs associated with investing. These costs can quickly add up and eat into your returns, resulting in lower profits or even losses. One type of fee that investors may encounter is brokerage fees, which are charged by the brokerage firm for executing trades on your behalf. These fees can vary depending on the broker you use, the type of account you have, and the types of securities you trade. Another type of fee is transaction fees, which are charged for buying or selling securities. These fees can also vary depending on the broker and the type of security being traded. Finally, investors need to be aware of expense ratios, which are the annual fees charged by mutual funds or exchange-traded funds, ETFs. These fees can range from a fraction of a percent to over 2% and can significantly impact your investment returns over time. So, how can you minimize these costs and maximize your returns? One strategy is to choose low-cost index funds, which are passively managed and have lower expense ratios than actively managed funds. You can also negotiate with your broker to lower their fees, especially if you are a frequent trader or have a large account balance. Another important tip is to avoid unnecessary transactions, such as frequent buying and selling of securities. Each transaction can come with fees and can also increase your tax liability. Instead, consider a buy and hold strategy, where you hold onto your investments for the long term and only make occasional adjustments to your portfolio. By being aware of the fees and expenses associated with investing and taking steps to minimize them, you can improve your investment returns and achieve your financial goals. Alright, so we've covered a lot in this video about the common mistakes that investors should avoid when investing in the stock market. We talked about the importance of having a clear investment plan, conducting thorough research, avoiding the herd mentality, staying calm during market turbulence, diversifying your portfolio, and minimizing fees and expenses. Now, I want to emphasize that successful investing requires patience, discipline, and a long-term perspective. It's important to remember that the stock market can be volatile and unpredictable, but by avoiding these common mistakes and following a sound investment strategy, you can increase your chances of achieving your financial goals. So, I encourage you to take the time to develop a clear investment plan that aligns with your goals and risk tolerance. Conduct thorough research and seek expert advice when necessary. Stay focused on the long term and avoid emotional decision-making during market downturns. Remember, investing is a journey, not a destination. It takes time, effort, and discipline, but the potential rewards can be significant. Thanks for tuning in to this video on the 5 common mistakes to avoid when investing in the stock market. I hope you found the information valuable and informative. Remember, investing in the stock market can be risky, but with the right strategies, you can minimize your risk and achieve financial success. If you enjoyed this video, please give it a thumbs up and share it with your friends and family. And don't forget to subscribe to our channel for more financial advice and tips. We're committed to helping you achieve your financial goals, and we'll continue to bring you valuable content to help you along the way. Thanks for watching, and we'll see you in the next video.